This is the video demonstration for corporate stock. In this video, I'm going to work the solution to example number 1. The information for example number 1 is included on the course website, and you have the option of printing out that information to follow along with the video, or you could just simply look at the video itself because I will be including all that information in the video. Now, the name of the company in this particular example is the Adams Company, and they have reported the following components of stockholders' equity. They have a class of common stock. It has a $10 par value. They have 50,000 shares authorized, but only 20,000 shares actually issued. They also have some paid-in capital in excess of par on the common stock, and that adds up to 44,000. And then they also have 124,000 in retained earnings. Now, during the year of 2012, says that the following transactions occurred, and we have a whole series of different transactions here. And on the requirements, we are simply required to prepare the necessary journal entries for these transactions. So we'll go through these transactions one at a time and record the journal entries. So the first transaction is on January the 1st. They issued 1,000 shares of common stock for $15,000 cash. Now, to do these journal entries, I'm going to utilize Excel. I have already set up in advance a format here with titles at the top. You could do this in Excel, or if you're doing a problem like this, you could even use your own paper. The first transaction is January the 1st. Now, in this case, we sold some stock. Now, anytime we sell stock, we're going to be receiving money. So that means we can debit cash, because cash is an asset, and I want the value of cash to be increased. And because I'm selling common stock, I'm going to credit common stock. Remember, with all equity components, the account behavior is debit negative, credit positive. So by crediting stock, that's positive for stock. Now, one rule about crediting stock is that I always want to make sure that I use the par value. I always have to use that. So in this case, this particular common stock has a $10 par, and we're selling 1,000 shares, but we're selling it for 15,000 cash. So up here on cash, I'm going to debit for 15,000, but down here on stock, I'm only going to use 10,000. Now, why am I doing that? Because I only can put the par value to the common stock. That's the reason why I have to use that 10,000, because each share has a value of $10. Now, there's a difference there of $5,000, and that difference needs to be on the credit side to make the journal entry balance. And what is that? Well, that's going to go to paid-in capital. And this paid-in capital is paid-in capital on our common stock. And that's just for all those instances where we sell additional value on the stock above the par value. So that completes that particular transaction. The next transaction occurred on January the 31st. We purchased 2,000 shares of our own stock for $34,000. Well, whenever we do something like that, that's actually called treasury stock. We're buying back our own stock. So I'm going to debit treasury stock. Now notice how that's a little bit different. Up here I credited common stock. That's because I was selling the stock. Well, down here when I'm buying it, it would make sense to do the opposite. So I'm debiting that and calling it treasury stock because it is my own stock. And I'm going to pay for that with cash. So I'm going to have to credit cash. And the amount involved is $34,000 because that's the price that they gave us. So we're spending $34,000 there. And if you go back and look at the transaction, since we purchased 2,000 shares and we paid $34,000, that insinuates that right now the market price of the stock is about $17. And I'm just going to put a little note there on the side to sort of remind me of that, because later on that'll actually come in handy to know that price of $17, even though it's not actually a part of the journal entry. Now the next transaction is on February the 1st. They declared a 50-cent per share dividend. It will be payable on February 28th to the February 14th stockholders of record. So this is a dividend declaration. And we talked about dividend declarations in our common stock video. Now, in this case, where does the money come from to pay out the dividend? Well, it actually comes from the retained earnings. So I'm going to debit retained earnings. And why am I debiting? Because remember, the equity components are debit negative. So I'll debit retained earnings. Now I'm not actually paying for this yet, but I'm obligated to pay for it. So that's a liability. So that's going to be dividends payable. See, I don't actually want to use cash there because I have not actually paid for it. The other thing I have to figure out is the amount for the journal entry. Now it said they're declaring a 50-cent per share dividend. But the question is, how many shares are actually out there in existence? Well, if I go all the way up here to the very top, at the very beginning of the problem, said they had 50,000 shares authorized, but actually only 20,000 have been issued. But then I issued an additional 1,000, which raised it to 21. But then I bought back 2,000. So really right now there's only 19,000 shares. So 19,000 shares times 50 cents. This is going to cost $9,500. So you see how I had to sort of figure out there how many actual shares are out there. Remember, I don't want to pay a dividend to myself. I don't want to pay dividends on the treasury shares, just the shares that are owned by individuals. Now the next transaction is on February the 28th, and this is a very simple transaction. We're just going to pay for the dividend that was declared on the 1st. So in this case, this will be February 28th. We're going to pay this $9,500. Now, previously I had credited dividends payable. Well, now because I'm settling this liability, I want to debit. And I'm going to pay for that with cash. So I'll credit cash. So that will remove the liability and show that I have spent $9,500 cash. The next transaction is on March the 1st. They sold 1,000 treasury shares for $18,000. So this is March the 1st. We're going to sell some shares for cash so I can debit cash. And I'm selling the treasury stock so I can credit treasury stock. Now in this case, it says that I sold 1,000 shares and I sold it for $18,000. So it's okay to debit cash for $18,000, but I don't want to credit treasury stock for $18,000. Now if you back up here and look at this, remember this note. I made myself a little note there, $17. Back when I first bought that treasury stock, that's what I paid per share. So when I take the treasury stock out, I want to use that same price. So if I'm selling $1,000, I had paid $17,000 for that. So there's a difference there of $1,000. So that's an extra $1,000 that we made by selling that treasury stock. So what is that going to go to? It's going to go to paid-in capital, but it's going to go to paid-in capital on the treasury. So it's not our regular paid-in capital, it's a special paid-in capital where we've made money just on the treasury stock. So that looks pretty good there. We made an extra $1,000 by doing that.